Good morning, Labaseritas. My name is Marco Francini. I'm the head of the EIB Group Office for the Baltic State. I would like to welcome you on behalf of the European Investment Bank and the Bank of Lithuania. We're very happy to have a lot of subscription today. For the attendees that have joined online, we will start with the opening remarks from Vitas Vaziuskas, Chairman of the Board of the Bank Lithuania, and from Mr. Östros, Vice President at the European Investment Bank. Subsequently, we will have two presentations. The first will show the key findings of the EIB investment survey for Lithuania and will be presented by Mr. Pedro de Lima and Mr. Koerner, economist at the European Investment Bank, followed by a Q&A session. The second presentation targets investment in Lithuania and will be presented by Mr. Darius Imbrasas, Chief Economist at the Bank of Lithuania, followed also by a Q&A session. Afterwards, we will have a panel discussion on investment in time of COVID-19, digitalization, and climate change, chaired by Ms. Kotrina Tamovicene, Head of Macroeconomics and Forecasting Division at the Bank of Lithuania. We will end the event with concluding remarks from Ms. Sandrine Crozet, Director of Baltic Sea and North European Department in the operation at the European Investment Bank. Of course, there will be, for the question, there will be a Slido that will be shared with you where you will be able to, ask some question to us. So without further ado, Mr. Vaziuskas, the floor is yours. Thank you very much.
Good morning, dear Marco. Good morning, dear Thomas, colleagues, presenters, and viewers. A warm welcome to this joint webinar organized by the Bank of Lithuania and the European Investment Bank. Allow me to thank the EIB for approaching us with the idea to hold this event. This is indeed a pivotal time to talk about investment. Decisions we make now on investment will be crucial in both the short term and, of course, the long term. Let us begin with the short term. According to the OECD, gross fixed capital formation in the euro area fell by almost 11% last year. This is a stark contrast to the United States, where the decrease did not amount to 2%. Investment will remain stronger in the US in 2021 as well. Accordingly, GDP in the euro area is now projected to recover to the pre-pandemic level only at the end of 2022. The US, meanwhile, is likely to make up for lost ground already this year. And China's output has not only bounced back fully, it is already at its pre-pandemic trend. Europe should not be satisfied with such outlook, and a stronger investment push is needed in the euro area to speed up our recovery and to catch up with the other large economies. Otherwise, we will not avoid painful long-term scaling effects. Public investment is key in this regard, especially in current low-rate era, characterized by historical low sovereign debt servicing costs as a share of fiscal revenue. As for the private sector, various surveys and reports are showing that uncertainty now stands as the largest barrier for private corporate investment. Even in Lithuania, despite its strong economic resilience displayed so far, we expect for the private sector investment to have fallen by almost 8% in 2020. But the policymakers can address this issue. Current research suggests that when firms grow risk-averse due to uncertain future, public investment becomes much more effective than usual. Not only does it have a higher multiplier, it actually crowds in private investment rather than crowding it out. That is, of course, if it is high-quality public investment that is well targeted and that enhance the potential output. This is why a consistent and speedy implementation of the next generation EU package will be so important in the near-term horizon for Europe. At the heart of the package is the Recovery and Resiliency Facility, or the RRF. By supporting member states' reforms and public investment, the RRF will provide an anti-cyclical fiscal impulse in the immediate term, much needed across many parts of Europe. And I do believe that it can catalyze private sector investment, given the current circumstances. However, we are at risk that European money will not be dispersed quickly enough because of administrative obstacles, or because the RRF plans put forward by member states simply lack ambition. Lithuania has a good track record regarding the absorption rates of European funds. We currently rank number 9 in terms of the 2014-2020 financial perspective. But we cannot grow complacent. Lithuania should take full advantage of the RRF funding and put forward a high-quality plan for the Commission in April. I mean a plan that is based on a rigorous cost-benefit analysis and in line with the European priorities. The Bank of Lithuania stands ready to mobilize its experts' capacities to help ensure that the plan advances a serious investment and reform agenda. This leads me directly to the discussion of the long-term perspective. According to the latest data, Lithuania's GDP decreased by 1.3% last year, beating the previous forecasts made both by us as well as international institutions. This is despite the ongoing second lockdown. In this light, the RRF is important to Lithuania, not so much as an immediate relief measure, but as a tool for long-term economic transformation over the coming years, and even, I would say, decades. Indeed, we need to think strategically of the post-pandemic world. At least 3 major forces will be shaping our future. Shifts in supply chains, number 1, digitalization, number 2, and climate change, number 3. Our investment strategies will have to accommodate these 3 trends. First, the pandemic has provided an impulse to at least partly reverse globalization. Vulnerabilities related to global value chains have been exposed. Countries and regions have declared their intentions to repatriate the production of strategically important goods. It is crucial that Lithuania, which has not yet achieved full economic convergence with the EU average, uses these global shifts to its advantage. We need to attract foreign direct investments that could help us enhance our participation in the recalibrated value chains. Focus should be on bringing in activities of higher value added so that we could provide a strong impetus to the growth of labor productivity and consequently the potential output. Second, digitalization has also been greatly accelerated by the pandemic. Restaurants and shops have digitalized to offer delivery services. People have been working remotely for extended period of time. We therefore need to invest in digital infrastructure, including 5G networks, to fully adjust to the new reality. Digitalization will also bring more automation and artificial intelligence, providing a boost to productivity. We should encourage this with our investment policies, including investment in human capital, so that the labor force can successfully participate in its brave new digital economy. Here, I see a connection with the third great force that will shape our future, climate change. Not only can investment in green technologies help reduce CO2 emission or bring about cheaper renewable energy, large-scale ambitious green investment programs can also help offset the negative effects of automation. the loss of jobs, and growing regional inequalities. Again, the Next Generation EU can become a good anchor for green investment. At least 37% of expenditure in each national RRF plan must support climate objectives. However, green investment needs are even greater. Under the European Green Deal strategy, the EU is committed to reduce greenhouse gas emission by at least 55% by the year 2030, compared with 1990. It is estimated that the green investment gap, the additional investments necessary to achieve this target, amounts up to 300 billion euros per year. Therefore, it's quite obvious that we will need to promote green investments on a national level as well. One of the ways to do so is to provide more leeway for green investment in the European fiscal framework, the review of which will likely resume in 2021. For instance, we could introduce a green clause which would exclude growth-enhancing green investment from the overall deficit target. This issue is as relevant to Lithuania as to any other member state, knowing that the European Commission considers to be at risk of missing our 2030 climate targets. Fostering a financial system that is financing climate-friendly investments will also be an increasingly important topic for central banks. Last year, the Bank of Lithuania joined a network of greening the financial system, aimed at scaling up green finances. Climate change, including risks caused by it that are not correctly priced by the markets, will also be considered in the ongoing ECB's monetary policy strategy reviews. Dear colleagues, to conclude, investment today is as important as ever. First, it can help repair to restore growth in the short to medium term. And second, it is needed to prepare for the long game. I therefore look forward to the upcoming discussions and presentations, including on the EIB's latest investment survey and its key findings for Lithuania. Thank you very much, and I wish very fruitful discussions. Thank you.
Mr. Velasquez, thank you very much for your contribution. I would like now to introduce you Mr. Östros, Vice President at the European Investment Bank. Thomas, the floor is yours. Thank you.
Good morning, Marco. Good morning, Vitas, and distinguished participants. I am delighted to be here today and to address you at this seminar jointly organized by Bank of Lithuania and the EIB, the EU Bank. We are very happy to welcome you to what we think is an essential discussion on investment and investment finance in Lithuania, but also in Europe as a whole. We are grateful to Chairman Vasilauskas and Bank of Lithuania for our excellent cooperation, and we are looking forward to many more joint events in the future. Today's seminar on investment comes at a crucial moment. Economies across Europe need to recover from the severe recession imposed by the COVID-19 pandemic last year. The Recovery and Resilience Facility is being implemented, and member countries are submitting their reform programs and recovery and resilience plans to the European Commission. Understanding national priorities for investments, as well as impediments and obstacles, is thereby of essence. Investment, both public and private, will play an essential role in the recovery. The level and the composition of investment will not only be key for the speed of the recovery, but also regarding the question of how well Europe and its members will adjust themselves to the post-pandemic environment, and particularly with a view to the other major challenges of our time, the green transition, and the digital transition. We have all been shocked by the loss of life and socioeconomic severities caused by the global spread of COVID-19 last year. But we were also encouraged by the solidarity as well as scope and speed of the concerted action taken on national, European, and global level. Together with the European Commission and the European Stability Mechanism, we at the EIB have been proud to provide our share of the 540 billion euro package of safety nets created last year to complement national efforts in the fight against the fallout of the pandemic. As a rapid response measure, back in March, the EIB was mandated by the Council to provide liquidity support to solvent companies suffering from the fallout of the pandemic through a 25 billion euro pan-European guarantee fund. The fund will make it possible to mobilize up to an estimated 200 billion of additional financing. In this context, last year, from the total financing of the EIB group that reached almost 77 billion, a third, 25.5 billion euros, supported COVID-related projects. As regards our activity in Lithuania, the EIB supported projects with 987 million euros, almost 1 billion in 2020. This is equivalent to 2% of Lithuanian GDP, the second highest figure among EU members after Estonia. Through co-financing with EU funds, our investments in the country included support for micro and small companies to weather the fallout of the COVID-19 crisis. The EIB group is playing a key role in EU efforts to fight the fallout of the pandemic, to find a cure, and to develop vaccines. To this end, we prioritized investments related to the health sector and research and development programs, while at the same time provided much of our support to small businesses. We signed loans to support hospitals and take pride in the fact that our quick support through a 100 million euro loan to the German company BioNTech contributed to the development of the first COVID-19 vaccine together with Pfizer. The pandemic has hit our economies hard. The speed of recovery remains surrounded by uncertainty, in particular with view to the duration of renewed lockdowns and the progress on the vaccination side. Different from the aftermath of the great financial crisis, Lithuania is not among the hardest hit countries this time. In fact, recent data releases show that Lithuania might be one of the countries that weathered the pandemic last year with the lowest loss in GDP, with an annual decline estimated at only 1.3%. A substantial drop in investments in the first 2 quarters of last year was partly turned around in the third quarter, but the economic and investment outlook remains surrounded by uncertainty. Our own EIB survey that Pedro and Kevin will present in a few minutes shows that both for Lithuania and the EU as a whole, the pandemic has strongly affected firms' investment decisions. In 2020, approximately 42% of Lithuanian firms expected to invest less than originally planned. On the other hand, only 25% of Lithuanian firms reported to abandon or delay investment plans because of COVID-19, compared to 35% as to the EU as a whole. It is no surprise that in the times of pandemic, the survey identifies increased uncertainty as the main barrier to investment in Europe. But next to uncertainty about the future, particularly the availability of skilled staff also remain a pressing issue. Our report shows that firms in Lithuania have become much less optimistic about the availability of external finance than the EU average, and the share of firms that consider themselves constrained regarding external finance, 14%, is more than twice as high as the EU average at 6%. Our survey illustrates that the EU is still lagging behind the US in the digital race. Lithuania here is no exception. Admittedly, important steps have been taken towards the required smart and green transitions in the EU as a whole, as well as in Lithuania. However, our survey results confirm that much more needs to be done in order to reach the EU goals of carbon neutrality. In Lithuania, only 26% of firms are investing in measures to improve energy efficiency, compared to 47% for the EU as a whole. 55% of all firms in Lithuania have already invested or plan to invest in the next 3 years in climate action, below the EU average of 67%. The EIB is more than ready to make its contribution to this crucial transition. In 2020, our main focus on investments in Lithuania was in energy. But beyond our traditional investment in energy security, we are now also significantly investing in energy efficiency, as we will no longer finance fossil fuel projects as of the end of 2021. It is clear investing in green transition cannot wait until the COVID crisis is over. At the same time, we cannot afford an investment gap in the aftermath of the pandemic. But economic recovery from the pandemic and investment in climate action are not mutually exclusive. In fact, they should rather be seen as closely correlated as large-scale investment in green technologies, research and innovation would bolster the competitiveness of European companies in the rapidly changing world that we are facing. The same applies to the ongoing digital transformation that has been further accelerated by the COVID-19 crisis. So to conclude, I'm hesitant to call the current crisis an opportunity, looking at the loss of life and hardship that it imposes on so many of us. But when it comes to the overdue structural transformations, times of crisis have repeatedly proven to be a game changer. Let us make use of the current one. I am much looking forward to our upcoming presentations and a lively discussion of distinguished panelists. Thank you again for having this seminar, and I wish you an inspiring morning. Thank you.
Thank you very much, Thomas, for this introduction. I would like now to introduce Mr. Pedro de Lima, Head of the Economic Studies Division at the European Investment Bank, and Mr. Kevin Kerner, Economist at the European Investment Bank. The floor is yours. At the end of the presentation, we will take some questions from the audience. Thank you very much.
Good morning. Good morning, participants. Good morning, Governor Vasilauskas. Good morning, Vice President Ostros. It's good morning, Marco. Thanks for introducing me. And Kevin, as Marco said, I'm going to talk about the investment survey that EIB has been conducting since 2016. And I'm going to split this presentation with my colleague, Kevin Kerner, who's an economist at the economics department of the European Investment Bank. The way we're going to split things is that I will give an overview of the survey in terms of its major overall results for Europe, and Kevin will narrow it down to the results we have collected for Lithuania. To give you an idea of what this survey is, I have this slide here where I've put together a number of covers for some publications that the economics department of the IB has been putting together for the last few years. We've just published the investment report for 2020-2021, which draws heavily on the results of the survey, but goes beyond the results of the survey. It's a comprehensive analysis of investment developments in Europe, and symptomatically, we called it building a smart and green Europe in the COVID-19 era. Basically, what we're doing with this report is tackling the question of what does it take to build to go through this green and digital transition, and what sort of an impact COVID has had on all this. Now, you can find this report in the IB's website. I invite you to download it. It's we call it a big brick because it has more than 400 pages of graphs, analyses, results. If you're interested in the particular results of the survey, you have also on the EIB's website, you have country fishes for all member states. You have also a country fish for the United States, and a country fish for the set of European countries. So you have a country fish for the European Union. The the survey is conducted annually on all member states, and we collect roughly 13,000 interviews among corporates. And this year, in addition, we also have conducted a survey among European municipalities. One very important feature of this survey is that we also conduct the exact same set of questions among US corporates. And this provides us with an invaluable benchmark because we can compare where European corporates stand vis-a-vis the American corporates. Now, in terms of results, and let me start it with the main results. We all know what happened. We've had a massive economic shock that comes from the pandemic shock. And at the same time, in Europe, we've had an impressive policy response. Both the governor and the vice president have highlighted the size of the European response. And as the VP Ostros put it very nicely, it had the pandemic triggered a wave of European solidarity, which needs to be stressed. At the same time, we know that investment has been hit hard, but something that one of the paradoxes that we are highlighting with the survey is that while firms are telling us, well, we need to cut on, or we are cutting on investment plans because of the crisis, if anything, has made it clear that we need to accelerate those investments because we need to prepare for the medium and long term. It's difficult to call it an opportunity, but in fact, the pandemic has sort of shown that there are opportunities in this digital and green economy, digital and green transitions, and this is what I will try to highlight in the next few slides. Very quite simply, in macro terms, Governor Vasilevskas has already described these slides. The shock to GDP was huge. We're not going to go back to pre-pandemic GDP levels before 2022, maybe later. The impact on investment is unprecedented. The impact in one quarter was way bigger than what happened during the first year of the great financial crisis. Now, what do firms tell us? 45% of firms tell us that they will decrease investment due to COVID in 2020. This is when we collected the data. The data was collected during the summer of 2020. And at the same time, when we asked them what you think is going to be the long-term impact of COVID, very clearly, more than 50% of firms told us there will be an increased use of digital technologies. So we need to adapt to this. As well, they told us there will be disruptions to the supply chain and in terms of service or product portfolios. But this is the main tension of the results of this survey. In the short term, the conditions are such that firms have to contract because they have problems, cash flow problems. They have to draw into their cash buffers, and so they have to cut on investment. At the same time, they all realize the need, or the vast majority of them realize the need to invest in this digital transition. Now, COVID didn't happen in a vacuum. We've been talking about the competitiveness problems of Europe for a while, and you can if you look at the graph on the left of this slide, you will see one of those problems, one of those competitiveness issues. And when we compare US and EU firms, you will see that the share of firms in Europe that are non-digital is considerably higher than in US. 37% of EU firms have not adopted yet a single digital technology. That number is below 30% in US. The gap is persistent. It didn't happen this year for the first time. And so this is not something that happened because of COVID. This predates COVID. And so when we're talking about a digital transition, this is one of the things that we need to look into and we need to tackle. At the same time, when it comes to the green transition, we see that European firms are somehow more committed to that green transition than US firms. And so here we provide you on the right part of this slide with some figures on the share of firms that have already invested, that's the purple bar, and the share of firms that are planning to invest in climate. And you can see that the European bars are both higher than in US. And the survey has a wealth of questions regarding the green transition and the perception of risks that both European and US firms tell us about this green transition. And we can see that Europe is more committed or European firms are more committed to the green transition than the US firms. This might change quickly. We know what's going on in the US. The change in administrations obviously might bring a different perspective to the green transition. But in fact, one area of concern for us is that if the gray bar is shorter than the purple bar, even for Europe, which means that it could reveal a percentage of firms that have already committed to invest in climate in the past and might not be so committed in the future. So even there, and this is also if you go deeper into the survey, we have a set of questions on what the firm's perception of transition risks on climate, and you can see that I don't think that European firms have fully internalized the risks associated with this transition. They very clearly see it as an opportunity, those who have a view, but they haven't really internalized the need to adjust to this transition. But this is something that if you are interested, I welcome you to look into the results of the survey, in particular the analysis that is contained in our investment report. An important element in these transitions do not happen without financing. And we've asked firms a wealth of questions about what are the main obstacles to investment. As Vice President Ostro said, the main obstacle for investment in Europe is these days uncertainty. Predating that, it used to be in the last waves of the survey, the main obstacle was lack of skilled labor. On the other hand, in addition to this, we see this year a deterioration in access to finance. We see that firms, although it remains a relatively contained problem, a relatively contained obstacle, firms have started to telling us again that access to finance is a problem. Europe, as we know, is not an homogeneous economy, and so if you go into the left, you will see that the range of share of firms who tell us that access to finance is a problem is quite different across different parts of Europe. The south of Europe seems to be much more worried about access to finance than the north and western parts of Europe. For the central and eastern part of Europe, where Lithuania is contained, it's somewhere in the middle. And now, what is also very important is that for firms, the main obstacle these days is not so much external finance, although that is also deteriorating. The major problem that firms tell us is internal finance. And this is quite understandable given the economic conditions that we face these days, because cash buffers are being wiped out. The pandemic doesn't allow firms to have a regular cash flow, and internal finance, the perceptions of the problems raised by internal finance have raised substantially in the last year or so. Now, these transitions are challenges. These transitions at the same time present opportunities for Europe. We need to invest in those transitions. To invest will unblock creation of jobs in both, given the green transition and the digital transition. But one thing that is crucial to support those investments is the question of skills. The type of jobs that are created by the green and the digital transitions tend to be concentrated on high skill jobs. And we hear from European firms that this is exactly one of the problems that they face, both in terms of digital skills or green skills. And but this creates some distributional aspects within Europe. And one of the things we do in our investment report is to look at regions across Europe that are more likely to be impacted by the risks associated with these transitions, the decarbonization and automation. And what you have in the map on the left, the red regions are the regions that are more at risk from this double transition. The good news for Lithuania is that Lithuania does quite well in terms of the risks faced by firms in terms of these digital and green transitions. Some of its neighbors, however, in Eastern Europe, are the ones that are more likely to be impacted by these dual risks. Before I conclude, something that has already been mentioned is the role of public investment. Corporate investment is a very important element in the recovery and in preparing the future, but the public investment needs to go hand in hand with the corporate sector. After the great financial crisis of 2008 to 2011, public investment has been on a decline, below trend. The good news this year is that public investment seems to be making a comeback. The commitments, as Vice President Ostros, by all member states of providing resilience plans that lead to the recovery of these economies is on the rise. Now, for public investment to be effective, we need to address questions of absorption capacity, of implementation capacity, and these are critical. And we have one chapter in the investment report that deals exactly with these topics. It draws heavily on the results of a parallel survey that we've conducted with municipalities across Europe, and we see that clearly the issues of technical capacity, not just financing but technical capacity, come on the way of allowing municipalities to be a more effective tool in rebuilding European economies. Now, the good news is that public investment is on the rise, and so it can provide a catalytic role to overall investment across Europe. Now, we don't know what's going to happen in 1-2 years, because we know that the debt positions of a number of member states are deteriorating fast, and that might compromise the whole of the policy mixes that we have for Europe. To conclude, investment is crucial. The digital and green transitions offer opportunities. Firms' investments are needed, are a crucial element in these transitions. We need skills. because human capital is as important as physical capital. Internal finance seems to be a problem these days, so we need to think hard and fast about how to provide equity type investments or instruments to European firms. The good news is that public investment is now a strong ally of this recovery, and these are the main messages that our report and our survey brings for Europe. I now give the floor to my colleague Kevin, who's going to tell you about the results of the survey for Lithuania. Kevin, the floor is yours.
Thank you very much, Pedro. I would now like to show you some of the key results of our Ibis 2020 survey for Lithuania. Our sample for Lithuania consists of interviews with exactly 400 firms. A bit more than half of them are micro and small ones, and the other part is medium and large ones. And it's relatively equally split between manufacturing, construction, services, and infrastructure. Now, Lithuania in many ways shows strong similarities with the general results for EU peers that Pedro just showed us, also in particular regarding the impact of the crisis. But there are also some country-specific results with view to investment, such as green and access to finance, that are important to be highlighted. So if we would move to the next slide. Please. What we see here is that Lithuanian we can clearly see here is that the pandemic weighs on both Lithuanian from short-term investment planning, but also on impacts on the long-term strategic considerations. So some of those results we have seen for the EU level before as well. Here it is again put in the context of Lithuania. What we see on the right-hand side is that that firms in investment strategies have been impacted in Lithuania as well in 2020. 42% of firms expected then to invest less than planned before, which is slightly below the EU average of 45% and 48% in the US. But we also asked what we saw in the EU context before, Lithuanian firms, what they think will be the long-term impact of the crisis on investment. And this is what we see on the left-hand side in the purple bars. And what we see here is that almost 60% of companies in Lithuania expect an impact of the crisis on their portfolio and of products and services. We see also that this is quite substantial, above the EU level of 40%. And the same applies to the supply chain. Also here we see about half of Lithuanian firms seeing an impact on their investment decisions and general business decisions in the future. What we also see, which is on the right on the left-hand chart, is that when it comes to digital technologies, even 64% of companies do see an impact, which compares to 50% on the EU level. So what we can see on this slide is basically we see a short-term impact. The chairman already showed before that Lithuania quite rapidly recovered last year from the drop in investment. But what we definitely see on this slide is that the crisis will have, at least from the firm's perspective last year, some lasting impact. I would like to move to the next slide. Thank you. So here is we are basically showing some of the major obstacles that Lithuanian firms identify when it comes to investments, or those are the main barriers that they see regarding their investment decisions. And what we see here is that, and Pedro also mentioned it before already, that availability of skilled staff is a major issue. It is one of the two most cited long-term barriers. 75% of firms see this as a major issue, see this as an issue, major and minor. And this is slightly below the previous year, so that is a good development, and also in line with the EU average, which is around 73%. Then at the same level, we see uncertainty about the future. Also 75% of firms in Lithuania see this as an issue. Remarkably, uncertainty in Lithuania did not increase during the crisis, and it is below the EU average of 81%. For the EU, this number increased. For Lithuania, it remained more or less the same, despite the impact of COVID-19. And as I said, for the EU, this is the major issue. We also see, well, we don't see on this slide, but we also in the survey report those numbers for the sectoral level. And there it's quite interesting that it's particularly the manufacturing sector that sees availability of skilled staff as a problem. 83% of firms report that there. And the uncertainty about the future is also the highest in manufacturing. And I would like to move to the next slide, please. This is about digitalization and innovation, and we heard a lot about this before. The vice president and the chairman mentioned both issues in their opening remarks, and also Pedro referred to that on the EU level. What we said for the EU before, that we are lagging behind the US when it comes to digitalization. That is something that applies to Lithuania as well. Our survey shows, this is what we see on the left-hand side, that 40% of firms say that they have not implemented any digital technologies at all. This is a bit above the EU average of 37% and 28% for the US. The number is a slight improvement to the Ibis results in 2019, where we saw it at 44%. So that is a good development. But we also show on this slide, on the right-hand side, that also when it comes to innovation, the EU and Lithuania are lagging behind the US. So basically, what we see here is the percentage of firms who say that they invest in innovation. Lithuania, we have a 56%, the EU at 58%, that they have not invested in innovations. 56% of Lithuanian firms say that, 58% for the EU as a whole, and below 50% for the US. One thing that we do not show on this slide is R&D investment, but that is important in this context too, also when it comes to the long-term competitiveness of Lithuania. Here we have on the EU level a share of 8% of total investment in research and development. In the US, it's 6%. In Lithuania, only 3%. I would like to come to the next slide, please. So this is on climate change, and again, here we heard a lot before. Pedro has presented to us the EU's leading role in climate action, and also when it comes to the interlinkage between green and digital. Also in Lithuania, a majority of firms feel an impact of climate change on their business. It's around 60%, comparable to the EU average. But despite the fact that firms are aware of the impact of climate change on business, they continue to lag behind EU peers when it comes to investment in climate action. And that is something that we see on the top left side. Here we split down in already invested in investment plan of Lithuanian and European firms. But if we take those numbers together, we can say that just about half of firms in Lithuania, 55%, report they already invested or are planning to invest in the next 3 years in measures to tackle weather events and reduction in carbon emission. And this as well, as we saw before, the EU average of 67%. It is above the US level, of course. But another aspect of green investment that we are showing here is firms' investment in energy efficiency. And also here we see that Lithuania lags behind EU peers. So the average share of investment in measures to improve energy efficiency in Lithuania is around 7% compared to 12% on the EU level. Now, when it comes to the impediments, the obstacles to investment in climate change, that is something that we show on the right-hand side. Here we list a number of factors that play a role. And here, in particular, investment costs seem to be a main obstacle, reported by 71% of firms, a bit more than on the EU level. And also uncertainty about regulation, almost 70%, and availability of finance, around 60%, are major issues. So these are issues that might require additional attention of policymakers as well. And since I just mentioned the issue, if you could move to the next slide, please. The issue of investment costs and availability of finance. This is a slide on investment finance in Lithuania in general. We saw for the EU level that external finance is a major impediment for some countries, but we also saw that internal finance conditions have deteriorated, of course, a lot during the crisis. Now in Lithuania, generally, this is not access to investment finance is not considered the biggest issue compared to factors like skilled staff and uncertainty about the future. But they do report quite strong constraints when it comes to access to external finance. And this is what we see on the right-hand side. So the purple line, this is Lithuania, and we see that now at 14% in 2020, the share of finance-constrained firms is more than twice as high as for the EU as a whole at 6%. We also see, as we mentioned internal finance before already, that Lithuanian firms even rely more on internal finance than on the EU level. This is what we see on the left-hand side. So it's about 70% compared to around 60% on the EU level. At the same time, and this is the thin green bar on the left side, the horizontal, we see that only 4% of firms in Lithuania are actually happy only to rely on internal finance. So when we look at those results, we see something similar than on the EU level. External finance will become much more important in Lithuania. At the same time, we see those constraints. Equity funding also here might be a preferable option. In fact, right now, equity finance plays a negligible role in Lithuania. And this brings me to the end of my presentation. I mean, to conclude, a lot of what we have seen for the EU level before applies to Lithuania as well. We have seen an impact on investment. The outlook remains uncertain despite the strong recovery in investment in the second half of the year and the relatively benign recession altogether in Lithuania. Investment decisions, this is what we've seen as well, are impacted by the pandemic, especially in the long term. The issue of lagging behind the US in terms of digitalization innovation needs to be addressed. Competitiveness needs to be strengthened. In green investment, a lot more should be done, and some of those factors that stand in the way of investment should need to be addressed. And when it comes to investment finance, external finance constraints need to be addressed, and the issue of reliance on internal finance as well. So as I said before, equity finance here might play a much more important role in the future. Thank you very much for your attention, and I'm very much looking forward to the rest of our seminar.
Pedro, Kevin, thank you very much for the presentation. Just for the audience, if you want the full report is on the IB website. So if you want more details, of course, the report is online, and we are of course happy to take any question. So we have from the audience one question. I will read it to you, and you can decide who will take the question. So the question from the audience is: how should the decrease in labor force in countries like Lithuania change the investment patterns and the need for financing of Lithuanian firms?
This is Kevin. Do you want to take this question, or do you want me to take it? Up to you. It's a Lithuanian question. So.
Yeah, no, sure, of course. I mean, that is something we saw in our survey that of course is a major issue, especially in countries like Lithuania. At least in the further past, I mean, we see that the demographic developments have become more positive in recent years. Also, we saw some migration patterns, not only outwards towards the rest of the EU, but in fact also the vice versa. So countries like Lithuania managed to attract skilled labor force from other countries as well. But I mean, it's a general trend. We do not only see in Lithuania or in Central Eastern Europe, but also in the rest of the EU. We see that the society is becoming increasingly on average older. We see that developments in the economy are speeding up in a way that also training and education needs to catch up much faster than previously. So in terms of finance patterns, I mean, I think a lot has to be done already before it comes to finance. First of all, we need even stronger alignment between education and both on the secondary and university level with the needs of the markets, to make sure that those skill gaps that we also see in our survey can be addressed, of course, within the countries already. If that is not sufficient, of course, the attractiveness to foreign labor needs to be strengthened. But if all countries are in this situation, of course, they are in a position where they compete towards skilled labor. At the same time, of course, that is something we haven't referred to before, but it's also in our survey. We see an underinvestment also in training and skills on the sides of companies. So I think in the future, companies, besides, of course, important investment in the productive capacities, also need to focus increasingly on in-house training. So training, obviously, for all of us does not stop at the university level or when we enter into our jobs, but that is something that will play a stronger role in the future as well. So, and of course, I mean, now I spoke mostly in the European context, but also, of course, in the global context. We saw when it comes to digitalization, especially our problematic position towards the US, where there's a lot of needs to catch up. When it comes to competition for skilled laborers, that is also an issue. I mean, when we talk about entrepreneurs going to the US or scientists going to the US from Europe, I mean, that is something we are facing altogether. So I think the attractiveness for skilled laborers, to keep them in the EU, to keep them in our countries, and that, of course, it depends a lot on the general conditions. So as long as we have this gap when it comes to digitalization and investment innovation, we also have difficulties to keep labor. So altogether, I think those things are strongly connected. The conditions are also necessary to keep talent within our countries.
Thank you very much, Kevin. Actually, you have also answered to a question that just came to the Slido, where you have already answered to the question: what are the major differences between the result of investment survey in Lithuania and other EU countries? I think this you have already answered. So thank you very much. I'm going to ask now a more let's say more general question, maybe to Pedro. So we've been talking a lot about climate change, and how about competitiveness? How can we combine green finance and innovation?
That's a very good question, a question that I really welcome, because as we said, both Kevin and myself and Vice President Ostros, the green transition is a challenge, but is an opportunity. And one thing that we didn't talk about in our presentations, well, Kevin touched upon it, but we didn't substantiate it, is when you start looking at the interaction between digital and green. And the good news there is, if you look at the patents issued in Europe versus patents issued in China or patents issued in US, where you're looking at the interaction between climate, green, and digital, Europe is in the lead. Europe has a lead on this area, and so this is good news, because it's the interface between innovation on green and digital that can take us forward, because we have a lot of ambitious targets when it comes to decarbonization of our economies, and to achieve these goals, we need obviously to change the way we produce. We need to change the ways we consume, but we also need to produce technologies that allow us to get there. And so this is a frontier that needs to be developed. And I used to call it before the European climate became the climate bank. This could be the race to the moon for Europe. The same thing that happened in the 60s when we raced to the moon, when the US raced to the moon and develop all the technology when the Russia or the Soviet Union and US were engaged on this competition to see who could put the first man on the moon, we can replicate it in a much nicer way, let's put it this way, with climate, because it's not a fait accompli that we are there, that we have everything we need. So we need to invest, we need to innovate in this area. And so I don't see a contradiction. In fact, this will take us to will shift the technological frontier upwards. And so it's an opportunity for economies in Europe to sort of face its competitive gap towards other parts of the world, notably the US. So I think it's a really step forward. And the IB is at the center of it all when it became the climate bank. And we are here ready to sort of finance these developments together with other partners, in cooperation with other parts of the world, because this is not who gets there first, but we all need to get there together. So I think that this is a really opportunity for Europe in particular to face its competitive challenges.
Pedro, thank you very much for the contribution. So there is another question on how does EIB cooperate with the local banks regarding the financial investment. So this
Marco,
question we will
you.
talk. Exactly. We will take this question at the end, at the concluding remarks, and will be explained by Ms. Sandrine Crozet, that is our director of operation. So Pedro and Kevin, thank you very much for your presentation. And I think now we can go to the next presentation. So I would like to introduce you Darius Imbrasas, Chief Economist at the Bank of Lithuania. And of course, we will take other questions at the end of his presentation. Thank you very much, Darius. The floor is yours.
It is a pleasure to be a part of this webinar, and a big thank you to Pedro and Kevin for a very interesting presentation. On my part, I will elaborate a bit more on the investment structure in Lithuania, and my presentation will show some of the findings of the recently published Bank of Lithuania discussion paper, named the same way as the presentation, A Picture of Lithuanian Investment. The structure of the presentation will contain four major parts. The first one will be investment structure and drivers. The second will focus on international comparison, which will be followed by a brief FDI overview, and I'll finish the presentation speaking about the public sector investment issues. So let's get started with investment structure and drivers. I'd like to start with a slide from the Bank of Lithuania's last presentation on economic convergence. Then we emphasized that Lithuania was among the leaders in terms of convergence towards the EU average. Over the last 10 years, labor capital and TFP have contributed similarly to GDP per capita growth, which stood at 5.5%. It was estimated that if the same convergence rate would continue into the future, Lithuania would catch up to EU average in a quarter of a century. However, the analysis also suggested that this will be difficult to achieve as the impact of labor factor will diminish. Thus, higher contributions from capital and TFP will be needed if Lithuania wants to maintain the same convergence pace. Here, the crucial role of investment comes into play, as it impacts both of these factors. When looking at the historical development, Lithuania's investment level has significantly fluctuated. As you can see from the chart, the highest investment levels have been reached just before the economic downturns, namely Russia's financial crisis and the global financial crisis, while the throes were reached just before the start of the economic recoveries. When, among other things, the country's capacity utilization levels were still low, and companies were finding it difficult to finance new investments projects due to poor financial situation. This impact was particularly strong in 2010, when the investment to GDP ratio fell to 90%, the lowest in the history. However, as economic recovered, the propensity to invest recovered as well. Investment growth, which started around 2013, has been observed until 2019, when it reached the long-term average again. The analysis made by my colleague allowed us to determine the main drivers of Lithuanian investment and how they contributed to previously mentioned fluctuations in investment levels. It showed that over the last 20 years, Lithuania's investment was mostly driven by demand factors. The most important of them were foreign demand, which is depicted in blue columns, and private consumption, depicted in purple. Uncertainty, depicted in green columns, also was among the main drivers of investment, and it was the main reason why investment grew in the recent years, as falling uncertainty fostered investment growth. EU funds, depicted in the yellow columns, also contributed to investment growth. But interestingly, in the short term, crowding out effects of private investment was found. Also, it is worth noting that only a minor role of supply-side factors, such as lending rates or credit, was found looking at the historical data. Changes in Lithuania's economic structure can also affect investment trends. In this slide, we can see investment value-added ratios of Lithuania's economic activities, which are depicted in bubbles in different shades of red. Each bubble represents a 5-year period, with a darker color showing more recent years. Blue columns show the share of value-added created by each economic activity. This chart shows three noteworthy things. The first one is that the investment intensities in economic activities are not the same. Also, they are not stable over time, and are subject to change. Secondly, biggest sectors in Lithuania's economy, namely manufacturing, trade, transportation, have relatively low investment intensities, while the highest investment levels are observed in activities related to public sector or its provided aid. For example, public administration, electricity and gas supply, water supply, agriculture. Thirdly, after the financial crisis, investment intensities fell in the majority of the biggest economic activities. However, from this chart, it is hard to see how these three trends impacted the development of the whole Lithuanian economy's investment level. One of the methods that could answer this question is to shift the shared decomposition. It decomposes changes in investment rates into three effects. A reallocation effect, which shows the impact of the changes in the sectoral structure of the economy, holding investment levels unchanged. Within sector effect, showing the impact of changes in investment levels in the economic sectors, holding structure of the economy unchanged. And the third one, dynamic shift effect, which represents the joint effect of changes in economic structure and investment levels. It is negative if expanding economic sectors have below average investment growth, or if the shares of the sectors with relatively high investment growth are declining. From the chart, we can see that growing share of less investment-intensive economic sectors significantly contributed to investment level decline. The negative impact of dynamic shift effect is seen in all three time periods, and the negative impact of reallocation effect is getting stronger in more recent time periods. Within the sector effect seems to be very procyclical, as in the longest time span, which includes both crises, it is negative, while in the shortest time span, which takes into account only recovery after the global financial crisis, it is strongly positive. This suggests that when analyzing investment development, a longer time span would be taken into account. It is better to take a longer time span into account, and ideally it would be to take a length of the business cycle. Until now, I focused mainly on Lithuania's investment structure and drivers. However, this analysis can't answer the question, is Lithuania's investment levels too high or too low? At least part of the answer to this question can be provided by comparing Lithuania's indicators with the neighboring countries and EU member states. Since 1995 until the financial crisis, Lithuania's investment rates were lower than in neighboring countries. At the highest level in 2007, they amounted to about 30% of GDP, while in Estonia and Latvia, the level reached 40 and 37% respectively. It is a bit of a paradox because lower investment rates didn't translate into lower convergence rates. During the period, Lithuania was one of the fastest converging countries in the EU. However, during the financial crisis, investment levels in all three Baltic states fell sharply. The recovery was stronger in Estonia and Latvia, while Lithuania's investment rate only reached EU average again in 2015, and was close to that level ever since. Comparison of investment rates of different economic sectors across Baltic states show that Lithuania's investment level in most sectors are lower than Estonia's and Latvia's, with some of the biggest differences being in sectors which create the largest share of value added, namely manufacturing and transportation. In Lithuania, there were only two economic sectors with higher investment rates than other Baltic states, one of which was information and communication, and the other one, quite interestingly, public administration. It is also worth noting that Lithuania's investment level of public administration sector is also among the highest in the EU. However, when comparing investment levels of economic sectors to the EU averages of differently developed countries, Lithuania does not stand out as a low investment country. Once again, Lithuania is strongly lagging in only a few economic activities. Unfortunately, those are the ones creating the largest share of value added. Part of the answer why this is the case can be provided by a deeper analysis of the structure of these sectors. For example, in Lithuania's manufacturing sector, a larger share of value added than in the EU is created in food, textiles, wood, furniture activities. These activities tend to be investment light compared to engineering or pharmaceutical activities, which compose a bigger share of manufacturing value added in other EU countries. When looking at the different types of investment, we can see that compared to the EU, Lithuania invests relatively more in other construction and transport equipment, and less in intellectual property products, which consist of R&D and computer software and databases and other capital goods. Higher investment in transportation equipment is explained by a rapidly growing transport sector in Lithuania. Its share of value added is twice as large as in the EU. Lithuania has also a quite high level of investment related to digitalization, namely ICT equipment and computer software and databases. It ranks in the top 10 among the EU countries in these investments. Lithuanian companies are continuing to allocate the increasing share of their resources to these investments, as in 2019 they reached historic highs of 3.2% of GDP. However, Ibis digitalization index show that Lithuania is among the most lagging countries in terms of digital intensity, infrastructure, process improvement, and monitoring systems. Therefore, further investment is needed in this area. Lithuania's lag in terms of investment into intellectual property products is mainly due to low R&D investment. Low levels of these investments can relate to economic development level. As can be seen from the chart, R&D investments tends to rise when countries' development level increases. While throughout the analyzed period, all Baltic states were closer to the least developed EU countries, which are depicted in the lightest shades of purple. Looking deeper into R&D investment, we can see that at the EU level, only a few economic sectors have high levels of R&D investment, namely professional, scientific, and technological activities, education, and manufacturing. In other sectors, the levels of R&D investments are low. Thus, economic structure is important in this context. In Lithuania, for example, trade and transportation generates almost a third of value added, but their potential to invest into R&D is low. Economic structure also plays a role in explaining the low levels of R&D investment in Lithuania's manufacturing and professional scientific and technological activities, which are far behind the EU average. For example, Lithuania's manufacturing sector is, as I mentioned before, dominated by activities such as food, furniture, all products, plastics, fertilizers, textiles. These sectors have low propensity to invest in R&D, while such industries as engineering and pharmaceuticals comprise only a small part of Lithuanian value added. The similar situation is also observed in the professional, scientific, and technological activities. However, the economic structure can only partially explain the low levels of investment into R&D. Even though such growth model worked thus far, it may be not enough to ensure economic convergence in the future. If Lithuania's companies invest in R&D, investment in R&D is limited, perhaps part of the activity could be generated by foreign companies. And indeed, empirical studies show that FDI brings R&D. Foreign-owned companies account for more than half of business R&D in Austria, Belgium, and Ireland. This allows arguing that attracting foreign capital could also increase our innovative capacity. Moreover, FDI can increase the competitiveness and productivity of the enterprises and contribute to technological progress in the country as a whole. However, FDI stock shows that Lithuania is at the tail of its neighboring countries. In 2019, country's FDI stock was only 38%, and compared to the decade ago, even declined. In recent years, financial and insurance activities and manufacturing have attracted the most FDI in Lithuania. However, the share of foreign capital investment in manufacturing has halved since the accession to the EU. With development of the services sector, more and more FDI has been attracted by financial activities. Foreign capital investment contributes to both productivity and wage growth as well. The influence of FDI per capita and wages can be seen by analyzing the data of Lithuanian municipalities. A figure on the left shows the relationship between the share of employees in the foreign capital enterprises and the average wage in the different municipalities. Municipalities with more than 1.5% of employed in the foreign companies are marked in blue, municipalities with less in yellow. In municipalities where the relatively large share of employees works at foreign-owned companies, wages are relatively higher. However, other factors may contribute to higher wages as well. The largest share of FDI per capita is in Vilnius County. It exceeds 16,000 euros in 2019, as you can see from the chart on the right. In the Klaipėda County, taking the second place, FDI per capita was 3.5 times smaller. However, it should be noted that FDI is registered where the receiving company or greenfield investment is registered. That might assign a significantly larger share of FDI to Vilnius region. Looking at the structure of the FDI, Vilnius County attracts most FDI to financial and insurance activities, also real estate operations, while the rest of the Lithuania to manufacturing. In recent years, Lithuania ranks high globally in terms of attractiveness to businesses. In the World Competitiveness Report, from a list of 15 indicators, the respondents had to choose 5, which they perceived as the main factors of attractiveness of the economy. The results show that number one reason for foreign companies to choose Lithuania is skilled labor force. High educational level listed third also adds praise to human capital in Lithuania. However, it should be noted that the shrinking workforce, accelerating wage growth, and slowing productivity growth may limit Lithuania's attractiveness to foreign investment in the near future as well. Infrastructure, listed as second, is crucial for investment climate as well. On the other end of the scale, there are factors such as competence of the government and competitive tax regime that could not be considered as factors of attracting FDI thus far. This leads us to the final part of my presentation, public sector investment issues. One of the first questions that arise when it comes to government investment is whether the sector invests enough. Let's start with the fact that Lithuania's general government sector is relatively small. Its expenditure to GDP ratio is much lower than EU average. Total general government expenditure in Lithuania in 2018 amounted to about 34% of GDP. It is more than a quarter higher, more than a quarter behind the EU average, which stands at 46.5%. The same cannot be said of government investment. It's ranked it ranged from 2.3 to 5.4% of GDP in the last 20 years. And even though before the pandemic, the government investment has fallen to just over 3% of GDP, it is still above the EU average. Should this be viewed positively? The answer would be yes, if there is no risk of crowding out of private investment. Economic theory argues that higher government investment can both crowd out and crowd in private investment. It all depends on where the government investment is directed. For example, increased spending on infrastructure, which includes roads, energy, education, healthcare, can increase the productivity of private capital and stimulate private investment. In Lithuania, government investment has a stimulating effect on private investment. In our analysis made in the paper, impulse response functions reveal that the first year after the government investment shock, private investment increases, and in the second and third years, only a slight crowding out effects are recorded. Crowding in impact also depends on where the government invests. For example, IMF has shown that government investment in health and social services significantly increases private investment in short run, while multipliers for other areas are lower. Thus it's not only the amount of government investment that's important, but also where it is directed. The largest part of Lithuanian government investments is directed to the transport sector, which includes not only vehicles bought, but also transport infrastructure maintained by the state funds. After the restoration of independence, there was a very clear focus on development of transport infrastructure. In 2000s, investment in transportation sector amounted to 70% of all government investment. This share has declined recently in recent years, and now it's in line with the EU average. According to the World Competitiveness Report, the Lithuania's road network is in a good shape. Both road connectivity and quality are well developed. This suggests that further investment should focus on maintaining the quality of existing infrastructure rather than developing new networks. If a government would overinvest into transportation, it will divert investment from other areas such as healthcare or education. For example, the latter would increase the level of human capital and facilitate the establishment of the research centers, engineering and pharmaceutical industries, the sectors with the highest propensities for an R&D investment. With this being said, I would like to end my presentation and give the floor to the panelists. They will discuss where to channel the investment in the times of COVID. Thank you for your attention.
Darius, thank you very much for your presentation. I have two questions for you. So the first one is, in your opinion, what are the reasons behind the low R&D investment in Lithuania? I know you have talked a little bit in slide 13, but what is your opinion regarding the reasons behind the low R&D investment in Lithuania?
Yes, so I think as we see at this data, which is provided not only of Lithuania but other European countries and world countries, countries usually start to invest in R&D when they reach a certain level of development. Let's say when they pick the low-hanging fruit of cheap labor, and they have to find new ways to grow. So one reason why is the case until now is that Lithuanian labor costs were pretty low compared to the other countries. Also, on the other side of the coin is that Lithuania until now doesn't have the let's say the infrastructure would allow normal and sustainable development of R&D investments. As I mentioned, in Lithuania, the value added created in the most R&D intensive sectors, manufacturing, scientific, professional, technical activities, are very low. And this is due to the fact that in those sectors, the companies which would make R&D investments also comprise only a small part. Let's say when we look at the scientific technological activity, the only sector which makes R&D is named the research activities, and their R&D investments are more than a third of the value added. But this sector in Lithuania is not developed yet. So from the one side, we can say that there is a lack. Maybe there is a lag for demand in the economy, let's say, and manufacturing, as the sector also does not have any need for R&D, as the most R&D intensive sectors are in the engineering and pharmaceuticals, and also other businesses still didn't found let's say the way how to incorporate R&D investments into their value-added creation, because until now low labor cost provided the needed competitive advantage to make a successful corporation. So for my part, this just to sum up, it would be three things: that until now Lithuania's development level didn't act for large R&D investments. Lithuania's economic structure doesn't have the needed companies developed in the economy, companies and sectors developed in the economy, and also question about human capital also raises if we have the necessary personnel to do those investments in Lithuania as well.
Thank you very much, Darius. Another very quick question is, given the poor Lithuanian productivity composition, can we say that Lithuania is stuck in a classic middle income trap?
Well, we got this discussion last year, and looking now at the development level of Lithuania's economy, we passed that middle income trap section, and we're now among the high developed countries and the lagging countries. So the situation now is that we need to find new ways to grow in the economy. And well, at least seeing what's happening in the terms of COVID, when our exporters increasing their export shares quite rapidly, I think the shifts in the economy is happening. Also, when we're looking at the investments into the digitalization related investments, they also are quite large, and they show that companies trying to reinvest in their growth models and be successful in the new environment as well.
Okay, Dario, thank you very much for your answer. Thank you very much for your presentation. So now, before we go to the panel discussion, there was a question related to if there is any study EIB investments in Turkey. No, at the moment we don't have, but of course, if there is interest, it's something that we could look at. So, thank you very much, Darius. Let me introduce Ms. Kotryna Tamovicene, Head of Macroeconomics and Forecasting Division Bank of Lithuania, to chair the next panel. Kotryna, the floor is yours. Thank you very much.
Thank you very much, Marco. And please, good morning, everyone. Please welcome our panelists. So today we will discuss with Ms. Vaida Česnulevičiūtė, Vice Minister of Finance of the Republic of Lithuania, Ms. Eivilė Čipkutė, President of the Association of Lithuanian Banks, Mr. Vidmantas Janulevičius, President of Lithuanian Confederation of Industrials, Mr. Alvaro Santos Pereira, Director of the Country Studies Branch at the Economics Department of the OECD, and Mr. Borja Gracia, Mission Chief for Lithuania from the IMF. A quick reminder to our audience, you're welcome to post your questions in the field under the broadcasting window in our website, and we will try to include some of them in our discussion. Well, obviously, we live in very interesting times, and investment has become a crucial topic for the recovery of global economy. And with the RRF, it's also quite an unusual situation that generous funds are available for investment, and then ideas and particular projects, where and how to invest is that million-dollar question. So let's start from the global view. Mr. Pereira, what changes did the COVID-19 pandemic bring in terms of areas that should be chosen as top priorities for public investment? And related to that, where should public investment in the context of COVID-19 be focused on? Like short-term, medium-term elevation of shock, or long-term structural transformation? Mr. Pereira.
Good morning, everyone. Well, thank you very much. It's a pleasure being here. It's a very good seminar. I really enjoyed it so far. So looking forward for the debate. I would like to start just a little bit with Lithuania. I think it's important to say that Lithuania was doing very well before the pandemic, was converging, the economy was doing fairly strongly. Also, we know that the pandemic, with the exception of Korea, of all the OECD countries that we follow, the second lowest recession that happened after the pandemic was in Lithuania, and this was partly because of the strong policy response. So what you should do is continue not only the support, but start planning for the future. So should you focus your attention on public investment as you ask for the short run, or should you focus on the long run? Clearly, on a global stage, the pandemic has accelerated clearly the digital transformation. Well, I think this seminar is a witness of that. And secondly, so probably a few months ago, I would have been there, and we would all be there in Vilnius to talk about these matters rather than being virtual. So this is a big improvement, including a contribution to the green economy, I should say. But we also know that in terms of Lithuania, there's public investment is not very high, and we know that there are some needs that you need to focus. So we believe that in the OECD, that after the fire is put out of the pandemic, it's very important to focus on the structural transformation. So we think that it's very important to have a very strong agenda of reforms together with public investment directed towards what can you continue to improve. You've done substantial reforms. What can you do for going forward? We think that for Lithuania, for many other countries too, but certainly for Lithuania, the focus should be on the digital infrastructure, digital reforms. We have some neighbors doing extremely well on this area. Estonia, for example, on e-government, I think is an example to emulate. But also on skills. What we see is that I think I think we just heard, in fact, this is highlighted also from the Bank of Lithuania. We know that school outcomes are still not very strong in Lithuania, and this is an area which I think can improve fairly dramatically. What the pandemic could bring into the structural transformation, I think, you're going to have a substantial amount of EU funds. You should use them not only to improve your digital infrastructure and continue to hard infrastructure too, but especially digital infrastructure, but especially the part on vocational schooling, vocational training. This is an area where you can certainly invest a lot more. So I think you should focus on reforms. You should focus on preparing how can you continue to boost competitiveness and the economy going forward. Structural transformation. Do not focus on the short run, because if you focus on the short run, this is the first step towards you making a mistake that afterwards is paid dearly. And finally, very quickly, you're asking me, should you give more emphasis to the private sector or the public sector? Well, we know that in the public sector, for example, Lithuania has a lot of SOEs, and so I think modernizing some of these SOEs should be part of the focus. But on the other hand, I think it's very important. What you need to do is to provide a strong environment for the private sector to prosper. And this, we come back to the reforms, and public investment should be an aid, especially in the short run, the mandate for the reforms, but basically supporting the needs that you need to do in order to continue to prosper like you did in the past few years.
Okay, thank you. Well, adding your view, Mr. Gracia, what would you comment? Should more of the COVID-19 related stimulus be channeled through public sector and its projects, or should they be allocated to private sector and their investment projects? As we observe that private sector is very careful at these times, uncertainty is really high, and perhaps the stimulus should also fuel private sector investment. What is your opinion?
Well, thank you very much for having invited me. I'm very glad to join from the other side of the pond. I agree with Alvaro that maybe this a few years ago or last year would not have been possible. So the emphasis on digitalization is critical. But let me just say that if this means I won't be able or we won't be able to travel as often to Lithuania, then it's not all positive. Now, let me provide some where I think can provide some more perspective and where our more comparative advantages. There is, and in the survey comes clearly, and in all interventions so far, it has been mentioned, low investment, it's a challenge or has been a challenge post-global financial crisis. And I want to just provide some focus on that. Why? Because this, the story was convergence in the region, in emerging Europe in general. Pre-global financial crisis happened at a speed that was comparable to the best cases so far, like South Korea. Now, post-global, but it was driven by very different factors. You had negative labor contribution, which did not happen in East Asia, and you have less contribution from capital. It was positive and significant, but less than in the best cases in East Asia, but definitely a much higher contribution from total factor productivity. And as someone in previous presentations were highlighted, with low investment, then you question the capital contribution, the capital accumulation contribution, and definitely lower investment should not support such high productivity growth going forward. And those were, that's the story that made some of us concerned and pessimistic about the speed of convergence going forward. I want to highlight one of the first things I want to highlight is that story requires some nuances. We might have been too pessimistic. It's not just the accumulation of capital investment that it's important, it's the marginal product of capital. One of the lessons of the global financial crisis is you can have very large capital accumulation, but if the allocation of resources is inefficient, and it was the imbalances of pre-global financial crisis clearly produced a misallocation of resources that was very large. The impact of that, it's long. The coming out of that is a protracted process, especially, the flow adjustments happened quickly in the Baltics in 2009 and 10. The stock adjustment, over leveraged companies that have invested in the wrong areas, that process of deleveraging happens very slowly, it's very protracted. And that's part of what explains the low investment in recent years. So the first lesson, I think, and Alvaro, I think, touched on that, is you need to avoid those imbalances, a growth model that is not sustainable and is based on those imbalances. So the emphasis should be on a productive investment that supports a dynamic, efficient, and productive private sector. And that obviously it's a role that the government, that public investment can support. Interestingly, we were going to focus on this because this is a discussion we've already had with the Bank of Lithuania, with the Ministry of Finance before COVID, which was lower investment. Is it still supporting high productivity, even though the level seems to be lower? And by the way, investment was the last big important indicator that reached the last one to reach pre-crisis levels. In Lithuania, the level of investment reached pre-global financial crisis levels in 2018 only. In Estonia, 19, and in Latvia, it hasn't yet. So I think that's one of the big lessons from the global financial crisis and an imbalanced growth model that Lithuania learned and did not repeat, and the Baltics in general. And that's very important. So for the first time, Lithuania's recovery and growth after the global financial crisis was balanced, avoided a boom, Now we've seen that avoiding the boom in the upturn also prevents a bust in the downturn, and that's critical to provide the stability and to allow more long-term planning and higher investment. I will elaborate on some of these on following questions, but I think I've probably talked too much already. So,
no, thank you, Mr. Gracia. Now let us turn to the public sector of Lithuania. Ms. Chesnulevičiūtė, since recently you are the Vice Minister of Finance, so what did you find when you came to the ministry? Does Lithuania have a long-term investment strategy? And then how is it affected by the ongoing COVID crisis? How does it look like when it comes to innovation, digital and green transition, which are those priorities everybody is pointing to today?
So I can say that I came in a good time, because actually now we are in the process of reforming our national long-term strategic planning process. And as Alvaro Pereira said, we shouldn't focus our investments just for the short run. We should think about the long term. So our new strategic planning system will allow us to plan our investments long term. It will show certainty also to the public and predictability for everyone, including the private sector. It will then give us clear strategic direction where we want to go at this as a state, what targets we want to reach, and then every sector will have their long-term investment plans. So, of course, COVID has an impact. However, it doesn't change the direction as such. We know that we lag behind in innovation. We know that we have to focus on climate change. We know that we need to speed up our digital transformation. So what COVID did, we can say that it actually speed up the process. And we have new opportunities coming with also the RRF. So we have funds coming in for the reforms, mostly targeted to green and digital transformation to ensure that as a state we emerge like a modern, competitive and climate neutral economy. Also the state, it doesn't only have to invest green, but also act green. So the new government have very clear ambition in the field of green transition, transition to the circular economy, to the climate neutral economy, but also to integrate into all sectoral policies. So we are not only intending to help business to transform into these models, also our sectors such as transport or agriculture to focus on stabilization on green gas emissions, but also as a state to act more green. So if we look, for example, at the public procurement, in 2019, as a state, we have spent more than 6 billion in euros on that. So it's almost 20% of our GDP. So the state is a very big purchaser. However, if we look at the percent of the green public purchases in that amount, we will find only about 3%. So if we take state as a customer that spend a significant amount of money in the economy, so if we will change our behavior as a customer, then also the supply side will have to adapt to the changing needs. So green public procurement is also high on the agenda, and we should see the shift in that. Talking about the digital transformation, we understand the need to upskill and reskill our human resources. Of course, digitalization will have to affect also all other areas like culture, public sector, construction, transport, like it goes without saying. But the very important aspect when we go through this transition, and I would like to repeat also what the governor Vitas Vasiliauskas said, we need to use public investment to crowd in private resources. And we already have some good examples of that. So very recently, we, together with the Ministry of Environment and the European Investment Bank, we launched innovative leverage fund that is intended to provide loans for and guarantees for modernization of multi-apartment buildings to increase energy efficiency. So the state only contributed 5 million euros, and we intend to attract 250 million through national and international private funds. So this is a very good example how state, by investing into certain areas and minimizing the risk that private investors could have, encourages them to contribute and participate in this process. So we have to always have in mind that public investments shouldn't go on their own. We always have to find the way to include private sector. Only then we can ensure a long-term perspective and generate additional value.
Great, thank you. That sounds very, very legit. But for the private business, not always. Transformation is a good thing. You know, it's not profitable for everyone, and it might mean a pain for someone, and the uncertainty remains high. So it's understandable that firms are very cautious with their investment decisions. And we heard in the presentation today that Lithuanian firms are lagging behind in green investment. So I would like to ask you, Mr. Janulevičius, how do businesses see their role in the economic transformation? Where do you see the government's role with a view to policy, regulation? And what else do you think could the government do to crowd in the private investment?
Yeah, thank you for possibility to participate in this very nice seminar and nice discussions. Finally, I was very happy to listen to Mr. Pereira and Mr. Grazia, about the investments in the private sector, because of course, government sector, we need investments in public sector as well. But too much investments in the public sector could create really disbalances in the future, because just private business increase the value in the long-term solutions, in the longer-term solutions. And my idea would be, we need to be balanced, of course. What means regarding the public sector and what means green investments for industry, of course, is very important, the energy prices. But at the same time, it's very important the rules which will be in European Union regarding possible CBAM mechanisms, carbon border adjustment mechanisms. This kind of protection, this is a possibility for the companies to invest in green economy and to know that wouldn't be leakage from European Union, and will be some on the border, will be the same mechanisms who could, let's say, push third countries to green transformation as well. That means they couldn't sell their goods, which was produced maybe somewhere in Asia with a big CO2 pollution. And this would be the main important role, how to attract the bigger businesses to go to the green economy. This is a major point. And I hope the CBAM mechanisms will be involved. Lithuania says for that, and Lithuanian industrialists says for that together with Business Europe as well. And I would like to come back shortly to the public investments. I think inside grid, electricity grid, it's a major important investments now must be done in Lithuania. As you know, 73% of electricity we bring abroad EU border. That means we are still most important under the electricity which is coming from Belarus and Russia. And this is really not our independence. If you want to create longer term sustainable economy, we need to have our own generation inside Lithuania. And of course, I'm talking only about the green generation. Offshore wind, wind onshore, solar and geothermal solutions could really avoid any fossil fuel usability inside Lithuania, in private houses, in companies and so on. Already renewables are really not as very expensive things. In some cases, they're even cheaper than existing market prices for electricity. But we need to have our own generation to feel safe. And of course, the more we will generate inside our country, inside European Union, the more added value will stay inside there, you know. And now every year, just for electricity, we export abroad around 400 million euros. Imagine what kind of amounts. And investment in this public sector is very crucial and important in the future, since 2025, to be disconnected from the Russia-Belarus grid and to be connected to the Western Europe part, which is on the way, but would be nice to intense more faster these kind of processes, which will create additional infrastructure inside Lithuania. This is a major point what I would like to say. And regarding the private investments, I listened before some speakers, and I really don't know from where we are receiving the statistics, especially regarding the research and development in our economy, because I took some figures from European Commission slides, which was inside. And what is interesting that since 2012 to 2019, Lithuania is #1 from economy-wise who invest inside research and development. It's 27.3% was increased during this period inside research and development. And of course, industries play quite biggest role during this period. Of course, maybe the last year wasn't the best result because this was COVID, but nevertheless, our economy shrink just 1.3%, when the industry produced plus 0.8% more things and goods was exported than in 2019, even higher. I would say so. This result that our economy just dropped 1.3%, mainly it's because the industry really still have a big value inside Lithuanian GDP. It's more than 20%, and I know only few countries inside EU where the part of the industry is still growing, and of course growing because a lot of investments in research and development, and of course in the digitalizing. And I still see and think there is a big potential here to invest in private sector, especially to bring them on another level. As previous colleague says, that we are still competitive with a cheaper labor cost, but our future is a really big added value things and products. And the same, just few sentences more, what I would like to say that since 2012 since 2008 and to 2018, we increased productivity in industry sector from 32,000 euros per year till 34,000 euros per year, 55%. Of course, it's still not enough to the EU average, which is around 60,000 euros per person per year, but we are on the right way, and we're investing inside automation and digitalization. That's mean final focus, we need to invest inside the really grid infrastructure for the electricity, because future is in electricity, e-mobility, heating, cooling with the heat pumps, renewable energy, all these things, absolutely easy to implement inside Lithuania. It's possible. We have all needed things to create added value there. I think this is a major point would be mine, but we need to create the same as a border adjustment mechanisms to protect our industry from third countries who wouldn't follow this kind of requirements.
Okay, thank you for your great insights. And now I would like to turn to Ms. Chipkute. You probably know quite a lot about investment decisions made by private companies. What do you think, what kind of incentives would motivate private companies or individuals investing in greener, more climate-friendly or digital solutions? Also, we have a question from the audience. What specific steps could be taken by domestic policymakers to increase the role of equity financing in Lithuania? Ms. Chipkute.
Good morning to everyone. Thank you very much for this interesting debate. And let me tell a little bit what is the role of financial sector in a green and digital transition in Europe, but also in Lithuania. So, and that refers to the long run more than the short run. So financial sector is financing 80% of the economy in Europe, which means it is going to be the main vehicle that is going to transform economy in Europe and also in our country into green. The main tool to do that is the so-called EU Taxonomy, which is a formula that allows businesses and also financial sector companies to measure themselves, how green they are. Now, the taxonomy is quite a new regulation and is still in the process of completion. And as for the banking sector, what we see, so we see two steps how we have to contribute to the green transition. And first of all is to translate taxonomy into the banking language. That is so that we banks also understand what does it mean to be green. Because that's the question that I hear quite often still. We talk a lot about green, but what does it really mean? What kind of investment must be done to be green? So that is the first challenge that we have ahead, and we are going to cooperate also with the EIB on that and look at their good experiences. They are the lead international financial institution on green investments. And as a second step, what we see as also association for us as a goal is to translate taxonomy into human language, which means to explain to businesses what does it mean to transform into green. Now, as we talk with the businesses, indeed, we see that larger companies in Lithuania, for example, are quite well aware what do they have to do, where do they have to go to become green. And also banks have already quite a bit of experience in financing, say, solar wind farms. So there's already an uptake on this investment. However, the main problem I see now is that to help smaller companies, SMEs, which still form a backbone of European economy, and also we have a lot of them in Lithuania. So to help them to transform their businesses into green. And that is actually still a question or a challenge I have to myself, because I don't understand what does it mean, a green SME. And I think that is going to be the ultimate challenge, to help to the smaller companies to do this transition. Now, talking about the digital transition. So fortunately or not, we don't have taxonomy there. However, that makes this challenge a little bit more complicated, because it's quite difficult to define what does it mean, digital transition. That's the only good thing I can say about COVID, that it really is transforming at a huge speed our economies into digital economies. And again, I will echo Alvaro that this conference is actually the future model of the businesses, where perhaps we are constrained physically in our country's offices or houses. However, we engage and exchange ideas globally, so there are no more limits for that. And this is going to be the future of the economy. Now, there are a couple of dangers in that. And these dangers are more or less the same across the world and in Europe, and also especially in Lithuania, I would say. And the first danger is that together with this green and digital transition, a lot of part of population is in danger to fall behind. So that is where I see the role of governments, to make sure that this sort of vulnerable part of population is not falling behind, especially in our country, because Lithuania is one of the most unequal countries in Europe. And the second danger is perhaps more dominant in Europe, and also in Lithuania, also was already mentioned, that is SOEs. The problem is that SOEs do not compete, and that makes green transition for them a little bit more complicated. And as a different example, we can say US, where big tech companies are moving to renewable energy in an enormous speed, and that competition is driving that. So that is a challenge to all of us, each of our country and European Union, I think, that we will have to address in the coming decades in order to reach the climate neutral economy. Thank you very much.
Thank you. And now I would like to turn back to Mr. Gracia and Mr. Pereira. You see, it seems like we all agree about the directions where the economy should move to. But as they say, the devil is in the details. So from your work with national public institutions, what are those major challenges for public authorities willing to invest public funds into those highly important changes like digitalization and green economy?
Borja,
or
should I start, or?
You can start, Borja, if you want.
Okay, thank you very much. So I think the biggest challenge, and this was mentioned in previous presentation, I think by the Bank of Lithuania, in our view, is to avoid the middle income trap. I mean, or at least a stagnant convergence where you just get stuck where you are right now. And the way to avoid that is to have a dynamic, competitive private sector that is the driver of growth and convergence. And for this, a successful convergence path, in our view, is one that shows high wage growth, that extends the benefits of convergence to the whole population. And you can only have sustained high wage growth if you have productivity supporting, at least in the tradable sector, in the competitive export sectors. So the role of the public sector to support this is very important, and it has been highlighted before. The government mentioned in the short term the possibility of even crowding in private investment with public investment. When the economy recovers and grows again, the public investment should support also private investment. I want to highlight one of the biggest challenges we see in this, and one of the biggest risks, therefore, we see here, and it's this conference, this survey, and the report by the European Investment Bank focuses on physical capital, but there is a need to look at capital comprehensively, and this is human and physical capital and the complementarity between them. And what do I mean? We've been talking, all of us, so far about the digitalization, the need for invest in a digital economy, but you can have a digital economy that, if you at the same time don't have the human capital to take advantage of that digital economy, then the benefits of that investment on digitalization will not materialize for the country and for the country as a whole. And I've been going to Lithuania now for 3-4 years. Everybody you meet, if you ask what are the top 3 priorities in Lithuania, everybody, public interlocutors, private sector interlocutors, credit unions, politicians, everybody says the top priority is education, the second top priority is healthcare, and then there is not unanimity on the third. However, a comprehensive education and healthcare reform have not happened over many years, over many governments, and that's a big challenge. And it's a big challenge because, as the survey identified, one of the big challenges companies face is this skill gap. So education, it's very important, and it's difficult to see how you can maximize the returns on your physical public investment and private investment if you don't have the labor force to match that. So in particular, this issue of the skills gap is very important. The education sector, one of the shortcomings is that it's producing skills and a labor force. It supplies to the market a labor force with the skills that are not necessarily matching what the market is demanding. And so going forward, this is very important. So what do we see as risk and opportunities over the next few years? With a new government, with the very large amount of resources available through the Resilience and Recovery Fund, through the Next Generation EU funds, there is an opportunity to match this amount of resources with the new government and obviously a new momentum of reform to complement all these investment projects with these other more challenging structural reforms that will maximize the returns on those investments. What are the risks? Well, the risk is one that this elusive reform of education and healthcare prove elusive in the next few years, continue to be elusive. The second risk, and I think it was also mentioned by many before and by the governor in particular, it's to ensure that the decisions, the allocation of investment is driven by quality concern, economic considerations, rather than more politically driven considerations that don't necessarily allocate the resources where they are more efficient. So in this, we think those are the biggest risks, and at the same time the potentially more promising areas for reform.
I agree with Borja. I just would like to add a few things. First of all, you're going to have an unprecedented amount of funds available to you in the next few years regarding because of the recovery plans. And so I think the challenge and an opportunity is that don't waste the money, because I think it's easy to waste many of these funds very often. So far, you've done relatively well in terms of using EU funds, but you could have a huge amount of money going forward, not only you, but many other countries. And so I think it's very important to, first of all, make sure that you use it to improve the competitiveness of the economy and to address some of the challenges that you still have, you know, in terms of infrastructure gaps, regional disparities, which are very large in Lithuania. And as Borja was saying, and I was saying before as well, it's the skills part. I think it's crucial, and so to develop good vocational training, or even consider developing a good dual and apprentice system, I think should be a top priority. But I think for you not to waste money, you also have to worry about other issues that happen not only in Lithuania but in many other countries, which is you need to have a strong institutional background and a strong institutional architecture to foster integrity and anti-corruption. Because very often when you have huge amounts of influx of money, this could happen, right? So you could have corruptive behavior and lack of transparency. And this is we saw this in many countries. And so I think it's important to reinforce the anti-corruption and foster integrity going forward. But I would like to say also that, as I said before, the priority should be reform. And the part on infrastructure that I think was highlighted before correctly, something that you need to do, it's exactly, and Europe needs to do, there are two things that need to be completed to complete the single market. One is, you know, the energy single market, or at least an energy market in which the grids from the Baltics to the Southern Europe have to be done in a proper way. There's too many energy islands around Europe, and this is something that investing in the infrastructure grid is crucial for the competitiveness of the Lithuanian companies and the competitiveness of Europe. So I think this should be a top priority going forward. It's not only the issue of green, is to have independence and to be competitive around Europe and around the world. The second issue that I think is very important to tackle regarding these issues is exactly, as I said, don't accommodate yourselves regarding the reforms. You've done a lot of reforms. Don't think that now you don't need, it's not time for reform. It is not now, but after the summer it will be. And so after the summer, you know, go back to the skills reforms, to the reforms that you need to undertake to address these issues, which are really large, and you should address as soon as you can. Thanks.
Thank you very much. Some very important issues you have tackled indeed. And now I would like to ask Vaida again, how does the new government of Lithuania see the issue of education and the infrastructure plans for Lithuania?
In terms of education, I can just echo what most of the speakers already said. Of course, we need to strengthen our human capital in order to be able to benefit from any investments we do, and to ensure that in the long run we emerge as a strong state. So, for example, even talking about digitalization, when we see what we lack most in the area is human capital. So if we don't have digital skills, we can invest however we want into the digital economy. There wouldn't be anyone to benefit from it. And even now, what we see is that we do have a very large inequality. And if we go forward with any of the reforms and investment as regards transformation of economy and infrastructure, and if we don't invest into the human capital, then this inequality will only deepen. And it can deepen to the level that we will be at the, I would say, point of no return. So we have to make sure that our education system, starting from the from the all levels, not only when we educate our pupils, but also when we look at the current workforce, how we reskill them, how we upskill them, how we make them adaptable to the future, or even I would say economy that we are on the edge on, and we have to, bring all the society on board to the transformation that is happening, and we have to ensure that from the transformation, society as a whole can benefit, and we are not just making our poverty levels and inequality even deeper. So investments into infrastructure need to go hand in hand with investment into the social human capital.
Thank you. And then the same question to Mr. Janulevičius: how does the private sector see their role in encouraging, human capital in Lithuania? I mean, if the education system is not sufficient, perhaps private incentives could help to benefit,
Yeah, thank you very much, Katrina. I fully agree with all participants and colleagues what they say. I'm very happy that we have more or less unique view from Central Europe, from whole Europe, from abroad and inside. And this is a major point, but I would say so where we need really to follow these directions, what we discussed together with Mr. Pereira, Grazia, and Ms. Chasnalevičiūtė. What I would like just to add new, because everything today was what people said, it's really absolutely correctly regarding the education. I just would like to see from the industry point of view where we have the troubles. It's interesting that in last 8 years, we participate, Lithuania in total, government institutions, research institutions and private institutions, we participated in 45 Horizon projects. And these 45 Horizon projects was mainly done not Lithuanian business with Lithuanian education, with universities and institutes, but it was with a foreign universities and institutes. The private sector mostly works with the foreign institutes and research centers. That's mean with Germany, with France, with UK, of course, from the past, with Belgium. I can taught a lot of plenty of universities, which we are, but not with the local ones so much. And this shows the biggest differences in mentality. At the same, our universities are in participation in consortiums together with another private companies from another European countries. This is okay, of course. Yeah, it's very nice. It's international cooperation. We increasing the value, knowledges, and so on. But this shows that still our education system, it's really not ready to work on applied science together with the industry. And it's better and more easier for me as an industrialist to talk with a Fraunhofer University, in Germany, or Constance University in Germany as well. They see the realities and they see the practical way how to improve our industry, in practical way, not just in science way. And this is, I think, the added point would be we need really to bring close our education system with the business to, in the future, to create the big added value inside our countries. This is a major point. And of course, without educated, I think, as we discussed, what the government must do, of course, we need to do the reform. We know that the reform was unsuccessful with education. And this is, you can see from abroad, as Mr. Pereira says, and we can see from inside. And we need more specific topics. Maybe we have too much universities. I don't know. We really need to make a conclusions. We need to be concentrated on some future areas where the economy will grow in the future. And I'm not the banking guy, but I understand that all this money, which is now mainly will come to all Europe and Lithuanian economy, in generally they are printed. It's no added value behind, But with this money, we can do really and invest in specific sectors, this money that in the future it would become as a reality with real added value. While, let's say, I think the energy and green transformation, it's one of the way. At the same time, we spend now money abroad to the third countries, a lot of money. Every day we spend between 1 and 1.4 billion euros every day from European Union. Imagine what kind of money we're spending abroad. And if we will change the e-mobility, green energy, and so on, we can create all this money, keep it inside our economies, which will generate additional value in the future as well. That means my idea would be, to invest the money which we're spending abroad, in case to keep this money to stay there inside our country, inside Lithuania, inside Europe Union, and for example, renovation as well. We need to do this in the newest way. This money would work, and we would have the money to pay back, because some of the money will be as a loans, and main of the money will be as a loans, and we not to overload our next generation with some additional taxes. To be more competitive. That's mean it was very exactly and precise. Mr. Pereira says we need to invest, but not to waste this money, and not to spend somewhere else on the public sector only, which will not create the added value in the future. We need to bring back this money, and we need to keep, of course, this added value for our children. Thank you.
Okay, so thank you very much. I see our time is up. And I would like to thank all the panelists for a really interesting discussion, great insights. And now I give the floor back to Marko. Thank you very much.
A very interesting discussion. So without further ado, I would like to introduce you to Ms. Sandrine Creuset, Director of Operation at the IB, for the concluding remarks. Thank you very much.
So thank you very much, Marko. I would like first to thank the Central Bank of Lithuania and the colleagues at EIB for the organization of this event. And of course, a special thanks to Governor Vasiliauskas and Vice President Ostros for their contribution, and to our panelists for the very interesting discussion and new insights, which I think gave us a lot of food for thought. What can we conclude? Well, I would say, okay, we can conclude this event saying that, of course, the pandemic and the related uncertainty have been a major obstacle to investment in Lithuania and, of course, in Europe. But when it comes to, let's say, midterm and long-term investment decisions, then maybe more structural factors as the insufficient availability of skilled labor or uncertainty in regulation equally play a role. I also, one of the main takeaway of today, I would say, is that, of course, a combination of public and private investments is crucial for a swift economic recovery after COVID. Finally, we also discussed the challenges and opportunities of the green transition and the digital transformation. And there we found that despite all the progress made, much more should be done and can be done. Now, maybe a few words about how EIB Group and actually our operation maybe could help and respond to the challenges that have been discussed. EIB has been active in Lithuania since 1994, and we have been financing projects both in the public and private sector. Now, as the Bank of the EU, we have a special position as we are here to support the local economies of our member states, but in accordance with the priorities which are being defined by them together at European levels. So this means that our role is first to listen to our clients, who come from the public and the private sector, and then to understand their needs, and finally to use all European financial instruments which are at our disposal to support them the best we can. So in this context, to be
in the position to even better listen to our counterparts, we have decided last year to reinforce our presence in the Baltic states, and we have now a regional EIB group office for the Baltic states located in Vilnius. You might have seen that in 2020 we had a record year for Lithuania at the EIB group, with almost 1 billion euro made available by the group. And actually in 2020, Lithuania was ranking the second in terms of EIB financing as a percentage of GDP. Now, the priorities have been twofold. It has been a combination of emergency responses to the COVID crisis, but also a continuous support to ongoing investments of the public sector, which is crucial to maintain economic activity, but also extremely important, the support to investments crucial for Lithuania's climate transition towards a carbon neutral economy. And there I will give you just 3 examples. On the crisis response, as underlined today, it became quickly clear that the SMEs, which are the backbone of the economy, would suffer the most, and that maintaining their access to finance was key. And as our study shows, since the outbreak of COVID-19, firms in Lithuania have become much less optimistic about the availability of external finance than the EU average. So the issue here is that banks tend to be more restrictive in crisis times with their lending, as higher risks impact their capital and hence their ability to lend. Now, what we have done last year, we signed a 170 million capital release operation with Luminor, which is active in the 3 Baltic states. And the final beneficiary of these operations will be SMEs also located in the Baltic states. And with the freed up capital, then Luminor will be able to maintain its lending volumes to the economy and possibly even increase it. So this operation, which has very concrete positive consequences on the economy, is the result actually of the cooperation between 3 European institutions working together. So the EIB, which is the originator of the coordinator and the coordinator of this operation, the EIF, which is the structuring specialist, and the European Commission, since this operation benefited from the so-called Juncker plan. So this is to give you an idea on how facilitating communication and combination of instruments can provide huge benefits to the economy. To respond to a question on the chat, which was also even more specific, when talking about support to SMEs, many people tend to leave micro businesses out of the equation, but our subsidiary, the EIF, does not. And for example, they signed 3 operations this year or in 2020 with Lithuanian alternative financing providers like Novity, Factoro, and the Central Credit Union. So the leverage impact of all these signatures is expected to be around 28 million euro, becoming available for local businesses and mostly to the benefit of micro entrepreneurs. So this was the first example. Then the 2 examples that I would like to mention, they relate to the more long-term trend that we should not lose sight of, which is climate change. An important level of EIB support went to finance energy projects, such as the modernization of the district heating of the city of Kaunas, or the investments in smart metering systems and IT solutions with Ignitis. But also to provide a wider perspective, we also supported Ignitis in its investments outside Lithuania last year through a structured loan, which was an investment in a wind farm in Poland. Now, as was mentioned before, we also helped individual homeowners in their energy efficiency investments. And as you know, this is a particular important sector for climate protection, in which investment needs are particularly high in Lithuania. So as was mentioned before, we have signed last year an agreement with Trialu Bankas to establish an innovative investment platform. And this is a particular important operation for us because actually here Lithuania is leading the way in Europe. This is a first of its kind in Europe. So this shows to us that, you know, by listening carefully at the needs of the market, you can design very innovative and very beneficial structures. Now, looking a little bit into the future, while we have, like all economic actors, a lot on our plate, we will keep working two ways this year, on the crisis response side, and then nonetheless keeping an eye on the long term. So on the crisis response side, the main challenge for us will be the implementation of the European Guarantee Fund. And this is a very important instrument because the aim of this instrument is to support the SMEs that have been severely impacted by the crisis. So here the EIB group is working very intensively to implement agreements with relevant actors in the economy. And this is quite challenging because, as you might know, the program as it stands now should be completed by the end of this year. With a view on the longer term, then, of course, we will continue also to support the investment activity in the country. The main aspect of our action will continue to be climate action and the support to environmental sustainability projects. For example, that was mentioned also by several panelists, we will continue looking for investment in the grids, in the green energy, but also in public transport or in water sector, for example. We are also looking at the next programming period, and the EIB, in combination with other national and EU instruments, for example, the next MFF, InvestEU, the EU Resilience and Recovery Facility, there we will work very hard to make those instruments workable and implementable so that they will be able to quickly support economic recovery. I would like just to maybe to complement responses to the question on the chat, which was how should decreasing labor force in countries like Lithuania change the investment patterns and the need for financing of Lithuanian firms. I would just like here to mention that, of course, digitalization of production processes is a possible answer. EIB is supporting such investments everywhere in Europe, in particular through loans to corporates who have R&D programs or who want to invest in the modernization and digitalization of their production processes. And as was mentioned also in the panel before, what we have seen and what is particularly beneficial to a project is when we have spillover effects in the projects, and we pay particular attention to that. What we call spillover effects are, for example, cooperation with universities or vocational schools, for example, for R&D projects, but also to ensure that the qualifications of the future workforce meets the needs of the economy. And we think this is key to have an inclusive transition to a carbon neutral economy. So as a conclusion, financing climate action, innovation, and SMEs will remain our three main priorities. And we are looking forward to continue to working with our partner and share, of course, our knowledge to foster investment in the coming year. I thank you very much, and I wish you a very nice day. I hand over to Marco. Thank you.
So, Sandrine, thank you very much for the concluding remarks. So I would like to thank you, all the colleagues at the EIB, and especially the colleagues at the Lithuanian Central Bank for the organization of this event. And we were a little bit late, but I think it was a very interesting discussion. So thank you very much, and have a good day to everybody. Thank you.